Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Teradyne.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And actually, before we really get into the mechanics of what is happening with Teradyne today, we want to mention a resource for those of you looking to improve how you read the charts.
Right, if you want a bit more clarity when looking at all this crazy price action, you can check out VIP Algos through the link below in the description.
Yeah, it's basically this TradingView indicator suite designed to give you visual buy and sell chart alerts.
Exactly. It outlines trend directions, maps out support and resistance zones, and, helps you plan, take profit, and stop loss areas.
And you can use it across multiple markets, so stocks, forex, crypto, gold, indices, you name it.
We do need to be very clear, though. VIP Algos is strictly an educational chart analysis tool. It is not financial advice.
Right, it is not going to automatically place trades for you, and it absolutely does not guarantee profits.
Because trading always involves risk. So you have to manage your own risk and do your own research.
And just as a heads up, that link in the description is an affiliate link, meaning we may earn a commission if you use it at no extra cost to you.
Okay, so jumping right in, let's look at why Teradyne matters so much to the market right now. Because if you've been watching the semiconductor space, you know how vicious the traditional cyclicality is.
Oh, it's brutal.
Historically, you have these massive, violent boom and bust cycles. Like everyone buys a new PC or a new smartphone, the chip makers spin up production, the testing companies get a flood of orders.
And then suddenly the market is completely saturated and the orders just fall off a cliff.
Exactly. But looking at the structural shifts happening today, it seems Teradyne is kind of ripping up that historical script.
Yeah, they really are. They're fundamentally breaking away from that consumer electronics cycle and morphing into this secular multi-year growth story.
Which is fascinating. I mean, they're no longer just a cyclical chip tester.
No, not at all. They have positioned themselves as mandatory critical infrastructure for the entire AI supercycle.
And that represents a complete psychological shift for how Wall Street values the stock, right?
Right, a massive shift. Because when you are tethered to whether or not consumers decide to upgrade their smartphones this year, your revenue is fragile.
Right.
But the build-out of AI data centers is not driven by fickle consumers. It is a multi-trillion-dollar, multi-year arms race between the largest technology companies on the planet.
And the physical complexity of the silicon required for these data centers means that rigorous advanced testing is no longer just like a quality assurance step.
Exactly. It is the central bottleneck of production. You physically cannot deploy these new architectures without Teradyne systems.
I want to use an analogy here because when you tell people to look at the AI gold rush, everyone immediately scrambles to buy the companies selling the picks and shovels.
Right. We all know who those big chip makers are.
But Teradyne isn't selling the picks and shovels. They are the company selling the highly complex, mathematically precise safety gauges for the heavy mining equipment.
That's a great way to put it. You literally cannot turn the machines on without them.
But that raises a massive question for anyone actually trying to build a portfolio. Like, what kind of investor does this suit?
That is a pivotal debate among institutional managers right now.
Is this purely a hyper-growth momentum play for someone with a high-risk tolerance? Or is this a growth at a reasonable price situation, like a GARP play, where you can build long-term wealth without paying an absolutely absurd premium?
Well, Teradyne actually straddles the line. It leans heavily into that GARP profile, which is honestly rare for an AI-adjacent stock.
Super rare. Usually the valuations are completely detached from reality.
Right. Yes, they are experiencing hypergrowth momentum on the charts, but unlike a lot of the speculative AI companies out there, Teradyne's actual bottom-line earnings are accelerating just as aggressively as their revenue.
So the underlying quality of the business is keeping pace with the hype.
Exactly. So it appeals to the growth chasers, but it also gives long-term wealth builders a way to get direct exposure to the AI data center build-out without buying into a company that has zero fundamental backing for its valuation.
Let's actually test that, though. If the fundamentals are supposed to back up the story, let's look under the hood and see what the engine actually looks like.
Let's do it.
Because the Q1 2026 numbers just hit, and frankly, it looks like a blowout.
Oh, it absolutely was. Revenue came in at $1.282 billion.
Wow.
Yeah, that is an 87% jump year over year, and their core semi-test division revenue crossed the $1 billion mark for the very first time.
That's huge. But the internal composition of that revenue is what you really want to pay attention to, right?
Definitely. Nearly 70% of their revenue in that quarter was driven specifically by AI-related demand.
Wait, up from what?
That's up from 60% just one quarter prior.
That is a violent acceleration in demand concentration.
It is. And because of how their business model scales, that top-line revenue is flowing straight down to the bottom line.
Which we love to see.
Their non-GAAP earnings per share skyrocketed 241% to $2.56. And their operating margins expanded to an incredibly impressive 37.5%.
Okay, wait. I have to play the skeptic here for a second.
Go for it.
An 87% year-over-year revenue jump for a physical hardware testing company is an anomaly.
It is very unusual.
If I'm looking at those numbers, my immediate fear is that we are witnessing a one-time panic buy.
Like they're just hoarding inventory.
Exactly. We know data center operators are terrified of supply chain bottlenecks right now. Are they simply hoarding testing infrastructure? Meaning Teradyne is pulling forward 3 years of demand into a single quarter, and next year the well goes completely dry.
It is a valid fear if you view all semiconductors as the same flat piece of silicon. But if you look at the mechanics of modern AI chip architecture, you realize why this test intensity is actually a sustainable, escalating baseline.
How so?
Well, Teradyne essentially operates within a global duopoly in the automated test equipment market. They command gross margins of 58 to 59%.
Which, for a company building physical machines, is completely unheard of. That sounds like a software company's gross margin.
Exactly. And the reason they can extract that kind of premium pricing power is because of how chips are now manufactured.
Okay, break that down for us.
They recently finalized a highly strategic partnership with Tokyo Electron, where they are combining Teradyne's testing platform with Tokyo's prober. This specifically targets the new 2.5D and 3D AI chiplets.
Okay, let's translate that for the listener. What does a 3D chiplet actually mean for the testing process?
Historically, a microchip was a single, flat piece of silicon. Testing it was relatively straightforward.
Right, you just check if it works.
Exactly. But today, an AI chip is constructed by stacking multiple smaller chips, which are called chiplets on top of and beside each other, connecting them with these microscopic pathways.
Think of it like building a complex three-dimensional puzzle.
Yes. And if you assemble the entire puzzle and then realize one tiny piece in the middle is defective, the entire multi-thousand-dollar package is completely ruined.
Oh, wow. So you can't just test it at the end.
No, the testing intensity scales exponentially because you have to test every single layer and every single interconnect before, during, and after assembly to protect the manufacturing yield.
Makes sense. So as chip architecture gets taller and more complex, the reliance on Teradyne's specific systems just goes up.
Exactly. It is not a one-time equipment purchase. It is a permanent architectural necessity.
So the competitive moat isn't just a brand name. It is deep, practically irreplaceable technological integration into the fabrication process itself.
You nailed it.
And what really cements the wealth-building aspect for me is the balance sheet. In a macroeconomic environment where borrowing costs have crippled a lot of infrastructure companies, Teradyne is sitting on zero debt.
Absolutely none.
And they are boasting an Altman Z-score of 33.77.
Which is mathematically phenomenal. For those unfamiliar, the Altman Z-score is a heavily tested formula that measures the bankruptcy risk of a publicly traded company.
Right. It factors in working capital, retained earnings, operating income, and market value.
Generally, any score above a 3.0 indicates a company is safe from bankruptcy.
And Teradyne is sitting near 34.
Yeah, which means their financial foundation is essentially made of titanium. On top of that, they maintain incredibly low stock-based compensation, only 2.0% of their revenue.
That's crazy low. If you look at their peers in the software and tech spaces, they routinely dilute their shareholders by 8 to 13% a year just to pay their engineers.
Exactly. They are actually protecting the shareholders' equity. That is a massive green flag for long-term holders.
So the fundamentals prove the business is healthy and dominating its niche. But fundamentals only tell us the intrinsic value.
Right.
The catalyst timeline tells us what events will actually force the broader market to wake up and reprice the stock.
And the loudest alarm bell ringing right now is their official addition to the NASDAQ 100 index, which takes effect on June 22.
This is a structural market catalyst, and it is incredibly powerful.
Inclusion in the NASDAQ 100 triggers what we call mandatory mechanical buying from passive funds.
I want to challenge that, though. We live in an era of high-frequency trading and algorithmic front-running.
Sure.
By the time retail investors hear that a company is joining a major index, isn't that flow of capital already completely priced into the stock? why would the actual inclusion date still move the needle?
It is a really common assumption, but you have to look at the mechanics of passive index funds. Trillions of dollars globally are tied up in ETFs that strictly track the NASDAQ 100.
Right, the Vanguards and BlackRocks of the world.
Exactly. The managers of these massive funds do not have discretionary power. They can't look at Teradyne, decide it's a bit overbought, and wait for a dip.
Oh, right, because they're strictly tracking.
Their legal mandate requires them to mechanically allocate capital to perfectly match the index weightings on the exact day of rebalancing.
That makes sense. That creates a guaranteed, immovable wall of institutional liquidity that must buy the stock, regardless of valuation.
So it is quite literally a forced buying spree.
And if we look just past that index inclusion, we run right into their upcoming fiscal Q2 2026 earnings in July.
Yes. Management has guided for revenue between $1.15 billion and $1.25 billion.
But there is a massive subplot to this earnings call, which is the $1.47 billion in supply chain purchase commitments that Teradyne is currently holding.
That is the friction point. A purchase commitment of nearly $1.5 billion signals that Teradyne's management is supremely confident that the data center demand is going to continue.
They're locking in the parts they need to build their testers.
Exactly. But the broader market needs to see a solid earnings beat in July to mathematically de-risk those commitments.
Right. If the demand is there, that $1.5 billion is a brilliant proactive move. If it's not, it's a liability.
Additionally, there is a very intriguing speculative catalyst circulating in the background.
Oh, right. The acquisition rumor.
There is a rumored $157 million acquisition for 75% of MLTP, which is a specialized AI data center I/O testing joint venture.
If that closes in the first half of 2026, as rumored, it immediately unlocks a whole new suite of unannounced testing contracts for Teradyne.
Okay, so we have the fundamental gravity of the company, and we have the catalyst providing the timeline.
Let's talk about how those forces are actually manifesting on the charts, because the technicals show us the literal footprint of the market's behavior.
The price action recently has been incredibly violent, but clearly bullish. We saw a decisive rebound off the $348 level, surging up to $407 in just 4 trading sessions.
It is actively targeting its 52-week high of $422.
And the momentum metrics are staggering. You are looking at a 30-day return of 28% and a year-to-date return of 108.3%.
And the vital confirming indicator here is the volume.
Yes. This 100% run is not being driven by retail traders on Reddit. It is confirmed by heavy, sustained institutional volume.
Whales are accumulating shares.
But surely a stock running up over 100% in 6 months is getting dangerously top-heavy.
Yeah, we actually just saw a pretty sharp 5.33% intraday decline, settling the price back down around $409.35. Doesn't that indicate exhaustion?
Context is everything on a chart. A 5% pullback after a 100% run is textbook technical behavior.
Right.
It represents healthy profit-taking by early buyers ahead of major catalysts, allowing the stock to build a new base of support.
It shows Teradyne is transitioning from a value play into a true momentum darling.
But you are absolutely right that charts show probabilities, not guarantees, and a chart moving this aggressively will experience heavy volatility.
That is exactly why active traders utilize tools like VIP Algos. When price discovery is happening this fast, visually scanning for those critical support and resistance floors helps strip the emotion out of the volatility.
Which brings us perfectly to the psychology behind the buying. We see the price structure, but what does the actual market sentiment look like right now?
Yeah. How divided is Wall Street on a stock that has already run this far?
Wall Street is largely bullish, but there is a fascinating tug-of-war happening over the valuation models.
Okay, what do you mean?
The average fair value target from consensus analysts is sitting around $374.82.
Which means, technically, the average analyst thinks the stock is currently about 15% overvalued.
Exactly. However, the most bullish targets on the street reach all the way up to $470.
A spread between 374 and 470 is massive. Usually, analysts are tightly clustered.
Yeah.
Does that spread indicate that Wall Street doesn't actually understand Teradyne's new business model? Or are the conservative analysts just lagging behind the reality of the AI cycle?
It is a textbook example of legacy financial models breaking down in the face of an unprecedented technological shift.
Explain that.
Well, the analysts pegging it at 374 are applying historical semiconductor cyclical multiples. They are assuming a bust is coming because a bust always came in the past.
Right.
The analysts at 470 recognize the secular break. They understand the 3D chiplet reality we discussed earlier.
And if you look at where the actual money is moving, institutional conviction sides with the bulls.
Oh, absolutely. Hedge fund Lone Pine Capital, which is a highly respected player, just initiated a massive new position in Q1.
That is a glaring signal of whale accumulation validating the higher targets.
And what really surprised me in the sentiment data is that the market isn't just buying Teradyne for the AI exposure. Investors are reacting incredibly well to their non-AI diversification. They recently locked down a $139.9 million contract with the U.S. Air Force that provides steady revenue through 2031.
Wow. On top of that, they just opened a new robotics manufacturing facility, specifically tapping into the cobot market collaborative robots designed to work alongside humans, which is an industry growing at a 21.4% compound annual growth rate.
That diversification is the ultimate downside buffer, and institutional money loves downside buffers.
Right. If the AI data center build-out hits a temporary speed bump, Teradyne isn't going to collapse.
Exactly. They have a multi-year defense contract and a booming robotics division providing an underlying revenue floor.
That is the bullish sentiment picture, but we have to flip the coin. We need to dissect the risks. Because when sentiment is riding this high on AI hype and whale accumulation, the fall can be brutal if the narrative shifts.
The core of the bear case starts and ends with the valuation premium. Teradyne is currently trading at a forward PE of 42.6.
Ouch.
That multiple is 46% above its own 10-year historical average, which places the stock in the 90th percentile of its historical valuation.
When a stock is priced in the 90th percentile, you are priced for perfection.
Yes. Any misstep in execution, any delay in an earnings beat, can trigger severe, rapid multiple compression.
Priced for perfection is a terrifying phrase when you look at their concentration risk. Yes, AI is driving the growth, but it now dictates 70% of their results.
And more critically, let's look at the geography. 36.2% of their fiscal year 2025 revenue came directly from Taiwan.
And we all know why. TSMC, the Taiwan Semiconductor Manufacturing Company, is the foundry building the world's most advanced chips.
Teradyne is inextricably linked to TSMC's output.
That 36.2% represents an enormous geopolitical bottleneck. If there is any escalation in the Taiwan Strait, or even a severe supply chain disruption in the region, a third of Teradyne's revenue is immediately threatened.
And if we tie that geopolitical risk back to the $1.47 billion in doubled purchase commitments we talked about earlier,
Right.
well, if AI capital expenditures decelerate because of a shock in Taiwan, those raw materials Teradyne bought don't turn into testing machines. They instantly turn into massive inventory write-downs on the balance sheet.
The inventory risk and the Taiwan bottleneck are undeniably the sharpest edges of the bear case.
They are, but if we go back to that 42 times forward PE ratio, we have to view it through the lens of their actual growth rate.
Right.
You have to contextualize the PE with the PEG ratio, the price to earnings to growth ratio. Teradyne's PEG ratio currently sits at an incredibly low 0.6.
Explain the mechanics of the PEG ratio for you as an investor, because that 0.6 changes the entire context of the valuation.
A standard PE ratio just tells you how much you are paying for today's earnings, but the PEG ratio divides that multiple by the expected earnings growth rate.
Okay.
Traditionally, a PEG ratio under 1.0 indicates that a stock is mathematically undervalued relative to how fast it is growing.
So yes, you are paying a hefty 42 times premium multiple upfront.
But because Teradyne's earnings are exploding, growing 241% year over year, that underlying growth is actually outpacing the premium price tag.
So the market has priced in perfection, but Teradyne is currently sprinting on a high wire and actually delivering perfection.
Exactly. That is a rare combination.
So pulling all of this together, the secular shift, the bulletproof balance sheet, the index catalysts, and the geopolitical risks, what is the final verdict?
Synthesizing the underlying data, we are giving Teradyne a bullish score of 8 out of 10.
Okay, an 8.
Yes. They have definitively solidified themselves as the premier AI data center test franchise. You have a flawless zero-debt balance sheet, exploding earnings growth that justifies the premium valuation through that 0.6 PEG ratio, and a widening technological moat driven by the complexity of 3D chiplets.
And looking at the target horizon, the near-term setup strongly aligns as a swing trade into the July 2026 earnings.
Right. That timeline allows you to potentially capture the structural, mechanical buying flows from the NASDAQ 100 inclusion in late June and ride the momentum leading into those fiscal Q2 numbers.
But we must explicitly state, this talk is not financial advice. We're not telling you to buy, sell, or hold Teradyne.
You must always weigh your own risk tolerance, especially when dealing with a high-momentum stock at the center of the AI narrative.
And if you are looking for a cleaner way to visualize these high momentum setups, be sure to check out VIP Algos through the link below in the description.
Yes, again, VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance mapping, and TPSL planning areas.
It is designed to make scanning the charts easier, but remember, it is only an educational chart analysis tool. It is not financial advice, it does not execute trades for you, and it does not guarantee any results.
Trading involves inherent risk, so always do your own research and manage your risk carefully. And again, that is an affiliate link, meaning we may earn a commission at no extra cost to you.
So as you watch this AI supercycle unfold over the next few years, you have to ask yourself a critical question.
Are you comfortable just betting on the companies digging for gold? Or do you want to secure a stake in the company that builds the mandatory scales used to weigh it?
And if this analysis helped you today, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua.